Hey everyone, and welcome back. Today we're going to be taking a deep dive into the world of subordinated debt,
Okay.
specifically how it works for small businesses. You know, that kind of loan that
Mhm.
basically takes a backseat if things go south. See your debt holders, get their cut first, and then whatever's left goes to the subordinated debt holders. We've got a whole stack of research and articles here, and our mission is to kind of help you figure out if subordinated debt could be a good fit for your business.
It's interesting. Subordinated debt wasn't originally intended for small businesses. It was really more of a tool for large corporations with complex financial structures.
Oh, interesting.
Yeah.
So how did it end up being a potential option for the smaller players?
Well, I think economic downturns played a big role. When banks get nervous, they tighten their lending standards, and that
Right.
makes it harder for small businesses to get traditional loans. So, subordinated debt kind of stepped in to fill that gap,
Yeah.
offering a lifeline to businesses that might not qualify for conventional financing. And then also, the rise of fintech made it easier to connect smaller businesses with lenders who are willing to take on a bit more risk.
So like a higher risk, higher reward kind of situation, both for the lender and the borrower.
Exactly.
That makes sense, especially for, a business owner who's really passionate about growth, but maybe doesn't have a ton of assets to secure a traditional loan. I know that, keeping ownership of the business is a top concern for a lot of entrepreneurs.
Absolutely. And that's one of the key benefits of subordinated debt. You get access to capital without having to give up equity right away.
Yeah.
But of course, that higher risk for the lender translates into higher interest rates for the borrower.
Okay, so higher risk, higher reward for both sides. Got it. So let's say a business owner is intrigued by this idea. What are the different types of subordinated debt that they should be aware of?
There are several flavors to choose from, each with its own nuances. Mezzanine financing, for example, blends debt and equity. The lender provides a high interest loan, but they also have the option to convert some of that debt into equity in your company down the road.
So it's like having a foot in both the debt and equity worlds.
Exactly. It can be a good option for businesses that are growing quickly and need capital, but aren't quite ready to give up a significant chunk of ownership just yet.
Essentially postponing those tough conversations about valuation until later when your business is more established and you have a better sense of its true worth.
Hmm.
What about convertible debt? I hear that term thrown around a lot, especially in the tech startup world.
Yeah, convertible debt is another popular choice, especially for early stage companies. It starts out as a loan, but it includes a provision that allows the lender to convert that debt into equity at a later date, usually at a predetermined price or based on certain milestones.
So it's like giving the lender a ticket to potentially join the ownership party down the line.
That's a good way to put it. And it's particularly helpful in early funding rounds when the company's value is still uncertain. Gives you more time to build traction and negotiate a better price for your equity later on.
Then there's revenue-based financing, which sounds pretty straightforward.
Yeah, it is. With revenue-based financing, you repay the loan with a percentage of your future revenue. It's a good fit for businesses that have strong, consistent income,
Okay.
but might not have a lot of tangible assets to use as collateral for a traditional loan.
So the lender is basically betting on your ability to generate revenue, and then they kind of share in the rewards if you succeed. Seems like a pretty fair arrangement.
Yeah.
What about subordinated bonds? How do those fit into the picture?
Subordinated bonds are debt securities that rank below other debts if a company goes bankrupt. Think of it like a hierarchy of creditors. Senior bondholders get paid first, then subordinated bondholders get whatever's left.
Right.
Investors who buy subordinated bonds are taking on more risk, so they typically demand higher interest rates in return for that added risk.
Okay, so we've got this pretty diverse menu of subordinated debt options. But let's get down to brass tacks. When does it actually make sense for a small business to consider this path? When is it a smart move?
There are a few key scenarios where subordinated debt can be a strategic advantage. For instance, let's say your business is poised for rapid growth. You've got a fantastic product, a solid team.
Yeah.
You're ready to expand into new markets or launch a new product line. Subordinated debt can provide the fuel you need to scale your operations without having to relinquish equity.
So it's like hitting the accelerator without giving up control of the steering wheel.
Exactly. And sometimes businesses find themselves burdened with a bunch of high-interest loans that are eating away at their cash flow.
Right.
Subordinated debt can be used to consolidate those loans into a single loan with potentially better terms, a lower overall interest rate,
Yeah.
and a more manageable repayment schedule.
It's like taking a deep breath and getting your financial house in order.
Yeah.
It's interesting how subordinated debt can serve so many different purposes. What about those times when a business might be facing a temporary cash crunch? I'm sure those situations can be pretty stressful for a business owner.
Absolutely. Unexpected challenges can pop up, disrupting even the best laid plans. That's where bridging financing comes in. It's a short-term solution to help you navigate a rough patch without having to make drastic changes to your long-term strategy.
So it's like a financial bridge to get you from a point of uncertainty
Yeah,
to a more stable position.
precisely. And then there's improving your capital structure, making your business look more attractive to potential investors by optimizing your balance sheet. Subordinated debt can play a role in that by adding a layer of funding that's less expensive than equity.
Okay, so we've got growth debt consolidation, bridging financing, even improving your appeal to investors. Seems like subordinated debt can wear a lot of hats. But what about those situations where a business simply can't qualify for a traditional loan?
Yeah, that's another area where subordinated debt can be a game changer. Sometimes traditional banks just aren't willing to lend to businesses that are in their early stages, have limited operating history, or maybe don't have a perfect credit score.
So it's like opening a door that might otherwise be closed, providing access to capital when other avenues are blocked.
Yeah.
It's like having a secret weapon in your financial arsenal.
That's a great way to put it. It's all about expanding your options and finding creative solutions to fund your growth. But it's important to remember that subordinated debt is a double-edged sword.
Okay, let's talk about the downsides. What are the potential risks or drawbacks that a business owner needs to be aware of before kind of diving into this world?
Well, as we mentioned earlier, the most obvious drawback is those higher interest rates.
Yeah.
That's a trade-off you need to seriously consider because those higher payments will impact your cash flow for the duration of the loan.
So it's like a high-stakes game. The potential rewards can be significant, but the consequences of miscalculating the risks can be pretty serious. What else should we be wary of?
Another important consideration is the increased risk of bankruptcy. Those higher interest payments mean you have less cash available for other essential business needs like inventory marketing or payroll.
Right.
If your revenue takes a hit, those debt payments can become a heavy burden, potentially putting your business in a precarious financial position.
Okay, so we need to be realistic about the potential downside. What about the availability of lenders? It's not like they're handing out subordinated debt on every street corner, right?
You're right. It can be more challenging to find lenders who are comfortable with the higher risk associated with a subordinated debt,
Yeah.
especially for smaller businesses. And even if you do find a willing lender, be prepared for a more rigorous due diligence process.
Yeah.
They're going to dig deep into your financials and want to understand your business inside and out before they commit.
So it's like going through a financial background check. You've got to be prepared to open your books and share your story transparently. I guess that's part of building trust with a lender, especially when you're asking them to take on more risk.
Exactly. It's a two-way street. They need to feel confident that you can manage the debt responsibly, and you need to feel confident that they understand your business and are genuinely invested in your success.
Okay, so let's imagine I'm a small business owner trying to figure out if subordinated debt is right for me. What are some of the key qualities or characteristics that would make a business a good candidate for this type of financing?
Well, the ideal candidate is a business with a proven track record. Lenders want to see a history of positive cash flow,
Okay.
a strong management team, and a business model that has the potential to scale.
So it's not for businesses that are just starting out or haven't quite found their footing yet.
Not necessarily. There are lenders who specialize in different industries and stages of business growth. The key is to find a lender who understands your specific situation and is comfortable with the level of risk involved.
Right.
But in general, a solid track record of profitability and a clear plan for using the funds to generate even more revenue are essential.
Okay, so let's say I found a lender and we're sitting down to kind of hammer out the details of a loan agreement. What kind of terms should I be prepared to encounter? Is there like a standard template or does it vary widely?
Loan terms for subordinated debt can vary quite a bit, but you'll typically see longer loan lengths than traditional bank loans, maybe 5 to 15 years.
Okay.
And as we've discussed, the interest rates will be higher, potentially in the 10% to 20% range, or even more depending on the perceived risk.
That makes sense. Longer terms, higher rates to compensate for the added risk. Anything else I should be aware of? Any hidden gotchas lurking in the fine print?
You'll definitely want to pay close attention to the fees. There might be origination fees, audit fees, monitoring fees,
Right.
and potentially even prepayment penalties if you decide to pay off the loan early. And then there are the covenants.
Covenants. That sounds a bit ominous. What are those all about?
Covenants are basically agreements you make with the lender about how you'll run your business. They're designed to protect the lender's investment by setting certain parameters for your financial performance and decision-making.
So it's like having a financial chaperone looking over your shoulder, making sure you stay on the straight and narrow.
That's a good way to put it. Covenants might include things like maintaining certain financial ratios, limiting additional borrowing, or providing regular financial reports to the lender.
Okay, so it's not just about getting the money. It's about understanding the strings that might be attached. I'm definitely sensing a theme here. Due diligence is paramount when you're venturing into the world of subordinated debt. You need to know what you're getting into and be prepared for the long haul.
Absolutely. It's not a decision to be made lightly, but with careful planning and a clear understanding of the risks and rewards, subordinated debt can be a powerful tool for businesses that are ready to take their growth to the next level.
This has been incredibly insightful.
Great.
We're going to take a quick break, but when we come back, we'll dive even deeper into the nitty-gritty of securing and managing subordinated debt. Stay tuned.
Sounds good.